The live intraday market for NUBURU is currently closed, and the stock finished its last trading session on June 10, 2026, at an exact price of 15 cents per share, marking a tough 5.88% drop for the day. While most penny stock traders look at a 15-cent valuation and immediately assume this company is quietly sliding into insolvency, what the broader market is completely missing is a massive geopolitical chessboard playing out in Europe. Just 48 hours ago, NUBURU filed a formal golden power notification with the Italian government. This is a highly specialized national security review required because this tiny American firm is aggressively attempting to acquire a 70% controlling stake in Tecne, an Italian defense and aerospace player. We are looking at an incredibly stark mismatch between a microscopic market capitalization and multi-million-dollar international defense acquisitions, creating a strange dynamic that retail investors are completely overlooking. The standard expectation when dealing with microcap industrial technology names is that their daily price action is dictated purely by dilution, retail speculation, or typical penny stock volatility. Retail investors looking at standard investing sites or tracking movements on a Robinhood app assume that a stock sitting below 20 cents has zero commercial visibility. The reality is far more complex. While individual brokerage accounts show a collapsing equity line over the past year, the company's internal corporate maneuvers resemble a firm with 10 times its current valuation. By utilizing specific technical platforms like an interactive brokers platform, institutional accumulators are seeing heavy trading volumes, with over 27 million shares swapping hands in a single session. This volume is massive for a company with a market valuation hovering around $26 million, proving that major players are paying close attention to these defense contracts, even as the spot price bleeds out. To understand why this expectation versus reality gap is widening, we have to look directly at the daily swings and capital structures that have defined the first half of this year. Back in May, NUBURU stock saw a sudden 8% surge, running straight into a hard technical resistance wall at 21 cents. For traders managing their portfolios through high-tier platforms like interactive brokers trading or tracking small-cap industrial funds via a Fidelity mobile app, that resistance level became a line in the sand. Every time the underlying asset attempts to build momentum, it gets suppressed by intense macroeconomic pressures and the constant threat of delisting notices from the NYSE American Exchange. The exchange recently flagged the firm for failing to maintain adequate stockholders' equity and issue management claims they are fixing by pushing their equity back up to roughly $3.2 million. If you treat this asset like a stable multi-billion-dollar bedrock such as Apple stock or Nvidia stock, you are missing the point. Those massive listings are stable giants, whereas this is a raw speculative technology bet facing extreme near-term execution risks. Let's look closely at the financials to see if the bear thesis holds water or if the contrarian buyers are onto something. In its first quarter earnings report ending March 31st, the company posted a modest revenue of $407,644. While that number seems tiny, it actually represented a vital turning point, pushing the company back into a positive equity position of $2.17 million, compared to a massive deficit of over $15 million at the end of the previous fiscal year. This sudden balance sheet cleanup is exactly why some aggressive wealth managers using sophisticated options or picking up fractional shares are willing to take a flyer on this ticker. The underlying daily swings show a clear pattern of accumulation on heavy red days, followed by sudden volume drying up on the green days. This points to institutional block trading, where larger firms use specialized accounts like a Fidelity brokerage or interactive brokers account to accumulate millions of shares without triggering massive retail spikes. Now, comment below how many shares of NUBURU you currently hold in your portfolio, or if you think microcap defense plays are too risky in this current high interest rate environment. To properly weigh the risk here, we need to contrast these tiny quarterly revenues with what the company is actually trying to buy. The Tecne acquisition values the Italian defense firm at €52 million pre-money. The full transaction structure involves a €64.6 million commitment, consisting of converting debt to equity, millions in direct cash injections, and revenue-based earnouts. When you look at the projection numbers attached to their Italian government filing, Tecne is modeling a massive €564.7 million in cumulative revenue between now and 2030. If the deal secures regulatory approval under Italy's strict statutory process, NUBURU's pro rata share of that revenue pipeline would be roughly $459 million. This creates a profound paradox. Investors logging into their retail apps are seeing a company with less than $500,000 in quarterly revenue, while the company is simultaneously positioning itself to absorb a defense asset generating hundreds of millions over the next 4 years.
For the average retail user executing an online investment through standard accounts, this massive divergence is almost impossible to reconcile. If you are handling your own self-investing or relying on a basic automated service like Schwab Intelligent Portfolios, your automated risk filters would likely flag the stock as an automatic avoid due to the extreme 52-week price decline from over $4 down to 15 cents. But automated systems cannot read geopolitical defense alignments. Beyond a massive Techne deal, the company's underlying business model revolves around producing high-power blue laser technology. Unlike standard infrared lasers, blue light is absorbed much more efficiently by industrial metals like copper, gold, and aluminum. This unique physics profile gives them a strong technological moat in specialty industrial machinery, electric vehicle battery welding, and high-tech manufacturing. Furthermore, their defense and security sector momentum is starting to show tangible signs of life through their subsidiary, Orbit. Orbit recently secured cumulative orders valued at $240,000 from a major national telecommunications infrastructure operator to handle advanced cybersecurity frameworks, cloud migrations, and software licensing through the start of 2027. Management has explicitly stated that they expect to complete a full 100% acquisition of Orbit by the end of this year, turning it into the primary software command layer for their entire dual-use laser platform. On top of that, they just signed a binding head of terms for a strategic alliance with an Italian developer named SunCubes to build out a dedicated laser arm specifically targeting the counter-drone and directed energy markets across the United States and European allied regions. This puts them directly in the path of massive modern defense spending trends. If you are evaluating this setup through standard online investing tools or cross-referencing it with stable sector plays like Tesla stock, the contrast is night and day. Large-cap tech stocks trade on clear cash flow multiples, institutional index inclusion, and massive consumer brand loyalty. A microcap industrial laser company trades almost entirely on contract wins, regulatory green lights, and capital survival. The core risk here is execution and cash runway. Pledging millions of euros for international acquisitions while navigating compliance notices from the NYSE American means management is walking a tightrope. If the Italian government blocks the acquisition during its 45-day statutory review period, the market expectation of a collapse will likely become reality, sending shares lower. However, if the regulatory clearances come through and the capital increase successfully funds the turnaround, the reality of a multi-million-dollar defense revenue stream will completely obliterate the current macro narrative. When you look at how people manage their long-term wealth, whether they are using comprehensive tools provided by Fidelity Investments, researching specialized equity pools via Fidelity ETFs or Fidelity mutual funds, or keeping cash in a Robinhood cash management account, the golden rule is always asset allocation. Putting significant capital into an unproven, highly regulated microcap defense asset is closer to venture capital than standard stock investing. But for nimble traders utilizing advanced tools like the Robinhood app for quick momentum trades or managing tactical specs inside individual brokerage setups, these deeply discounted tech names offer asymmetric setups where a single regulatory press release can double the asset value overnight. Let's cleanly summarize the core realities governing NUBURU as we head into the summer. The central insight here is that the stock market is currently pricing this asset based on its historical balance sheet issues, exchange non-compliance flags, and tiny tax revenues. That is the expectation, and it is why the stock is sitting at 15 cents. The reality, however, is a company actively transforming itself into a dual-use defense platform through massive pending European acquisitions, fresh cybersecurity contract wins, and highly specialized directed energy partnerships. This stark contrast between a depressed public market valuation and an aggressive cross-border corporate expansion creates an incredibly volatile environment. Whether this stock represents a terminal value trap or a massive asymmetric defense tech opportunity depends entirely on those looming regulatory approvals in Italy. Keep your eyes on the volume patterns and the statutory review timelines, as they will dictate exactly how this narrative ends. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thank you. Don't forget to like, comment, and share this video to support the channel.